Dive for Financial Intelligence, your daily source for, well, sharp, focused market insights. It's Saturday, and let's be honest, right? The only futures most people are probably trading today involve brunch reservations, maybe some laundry loads. But for those of you still keeping an eye on the tickers, here's what really mattered yesterday. Today is Saturday, September 13th, 2025, and we're bringing you the intelligence brief for yesterday. That's Friday, September 12th, 2025. And what we're seeing across the globe, it's a fascinating paradox, really. We've got record highs in some pockets, pretty significant dips in others, and, well, a real divergence in the underlying economic stories. So our mission today is to try and unpack what these contrasting signals truly mean for the global financial landscape, and importantly, for you. This update is powered by Nextsight. They're a global intelligence and investigations firm that honestly goes way beyond just collecting data. With their open source OSINT platform, Site Connect, they really transform raw signals into actual strategy and let clients tailor reports to their precise priorities.
From market analytics to cross-border investigations, their work consistently operates on another level. You can learn more at www.next-site.com. Okay, so let's unpack this. This contradictory market picture, we saw global equities presenting a really mixed bag yesterday, almost like a financial mosaic with pieces pointing in completely different directions.
That's exactly. Yeah, mosaic is a good word for it. The headline grabber was definitely the Nasdaq Composite. It soared to a record high, 22,141, up about 0.45%. Oh. And this wasn't just like general tech good feeling, it's very specific. Microsoft had some sharp gains after settling a big EU antitrust probe.
Ah, right, that's settled.
Yeah. And Tesla jumped. Get this, 7.4%. That was mostly off the back of CEO Robin Denholm's comments, sounding really confident about strong consumer demand. Mm-hmm. It just shows the power of those big tech names in the whole AI narrative right now.
Wow, 7.4% for Tesla. That's huge.
It is. But here's where that paradox you mentioned kicks in.
Yeah.
It wasn't, a rising tide lifting all boats, not at all.
Yep.
The broader S&P 500 actually duped slightly, down 0.05%, basically flat but down. Yeah. The Dow Jones fell more significantly, 0.59%.
Okay, so what dragged them down?
It was largely sectors like healthcare and materials. Interesting detail, vaccine makers were among those dropping, apparently after some concerning report came out linking shots to adverse outcomes. So yeah, it tells us that beneath that tech euphoria, there are definitely some real areas of, let's say, vulnerability or just sector rotation.
Right. In Europe, how did things look over there?
Europe also showed some caution. The STOXX 600 slipped just a bit, 0.09%. A lot of traders were sort of on edge, specifically waiting for Fitch's review of France's sovereign rating. We'll get to that later, I'm sure.
Yeah, definitely.
UK's FTSE 100 also eased back, down 0.15%. But then you look across Asia, and markets there were largely positive. Japan's Nikkei 225 gained almost 0.9%, and Korea's KOSPI leaped 1.54%.
And what was driving Asia? Still tech.
Yeah, again, largely fueled by strong performance in tech and chip makers. So you really see this ongoing global split. Tech strong, some other areas less so.
It's really clear, isn't it? While tech's driving these records, a lot of the market seems to be signaling, well, caution. But beyond these big equity indices, what other corners of the financial world saw significant action yesterday?
Oh, plenty. The ripple effects were felt across quite a few asset classes. U.S. Treasury yields, for instance, they rose modestly. The 10-year closed at 4.07%.
Okay.
Then you look at energy. Oil prices gained pretty significantly. That was after a Ukrainian drone strike hit Russia's Primorsk port, apparently disrupting some crucial loading operations there.
Right. I saw headlines about that.
Yeah, so Brent crude settled at $66.99, up almost 1%, 0.93%, and WTI closed at $62.69. So a definite impact there.
And gold, still strong.
Gold, yeah. Playing its traditional role, it continued to hold near that all-time high, sitting around $3,648 an ounce. That's largely driven by expectations, that the Fed is going to cut rates soon.
Makes sense. What about currencies and crypto?
Well, the U.S. dollar index, the DXY, it edged up a little bit to 97.58. Seems like investors were just positioning themselves ahead of next week's Fed meeting. And speaking of, let's call it speculative interest, Bitcoin climbed impressively. It hit $116,777. Yeah, that's its highest level since mid-August. Really shows a strong appetite for digital assets right now. What's really striking here, I think, is how quickly things connect. You have one geopolitical event, like that drone strike, and boom, it instantly translates into higher energy costs. And at the same time, you had the anticipation of future monetary policy, like those Fed rate cuts everyone expects, pushing assets like gold and Bitcoin to multi-month highs or even all-time highs in gold's case.
It really underscores how interconnected sentiment and, well, hard news are these days.
Absolutely.
Okay, those numbers paint a truly diverse, almost contradictory picture. But let's dig a little deeper now. What's the underlying economic story unfolding? Especially thinking about consumer health and the financial stability of nations. Is this mixed market telling us something important about potential economic fault lines?
Absolutely. I think it is. If we zero in on the U.S. macro data that came out, the University of Michigan's Consumer Sentiment Index, it fell. Fell to a May low, actually, 55.4.
Oof, that's quite a drop.
It is. And it's not just a number, right? It reflects growing concerns among regular consumers about business conditions and, crucially, about inflation expectations. It's definitely not a confident outlook.
Any other U.S. data?
Yeah, adding to that picture, U.S. weekly jobless claims increased to 263,000. It's not a huge jump, but it does suggest a discernible softening in the labor market.
Okay.
So when you stitch these data points together, lower sentiment, slightly higher jobless claims, it really reinforces those market expectations for an imminent U.S. rate cut from the Federal Reserve.
The message seems clear then. The economy's slowing, and the market expects the Fed to respond.
That's the prevailing narrative, yes. And it wasn't just the U.S. showing some strain. Across the pond, the U.K. also showed signs of struggle. Their July GDP growth, it stagnated.
Flat GDP.
Not great, no. And manufacturing output actually fell 1.3%. That subsequently caused the pound sterling to dip against the dollar. So another signal that economic momentum is stalling in some key regions.
Okay, this is where, as you hinted earlier, it gets really interesting. And maybe a bit dramatic, actually. The news from the rating agencies. This isn't just about numbers anymore. It's about sovereign health, investor trust.
Indeed. Huge news here. Fitch delivered a pretty significant blow by downgrading France to A+ aft, and they were explicit, citing the political turmoil there and persistently high debt levels.
So not just a technical adjustment.
Not at all. This underscores some deep investor anxiety about fiscal slippage in a major European economy. It really raises questions about France's ability to enact necessary reforms, given the political situation.
Wasn't there contrasting news, too?
Yes, and this is the fascinating part. In sharp, almost poetic contrast, Fitch actually upgraded Portugal to A, and S&P Global Ratings raised Spain to A+ deck.
Wow, okay. Why the upgrades?
Both agencies attributed the upgrades to improvements in their fiscal health and, importantly, sustained efforts in debt reduction. So they're being rewarded for fiscal discipline. This isn't just about individual countries' finances, though. It's a stark illustration of how investor confidence is now actively, maybe even aggressively, differentiating between European nations. It's based on their perceived political stability and their agility in making reforms.
So it kind of challenges that old idea of a monolithic Eurozone.
Exactly. It highlights potential new fault lines that are definitely going to affect borrowing costs and investor confidence, probably for years to come. Very significant divergence there.
That's a really powerful insight. It shows how the market is now maybe picking winners and losers based on political resolve as much as economic numbers. Let's zoom in further then. Let's explore the specific drivers within each major asset class. What's truly pushing the needle in equities, rates, real estate, and the rest, from an investor's point of view?
Okay, yeah, let's break it down. Starting with equities, we had to come back to that Nasdaq record close. It was driven by that continued, almost insatiable enthusiasm for AI and just the stellar performance of big tech. Specifically, you had Microsoft getting that boost from the EU antitrust settlement we mentioned, and Tesla surging on CEO Robin Denholm's confident remarks about demand.
Right, the big names pulling the weight.
Very much so. However, beneath this sort of high-flying narrative, we definitely saw clear sector rotation. Healthcare, materials, they lagged significantly. But here's maybe the most insightful nugget, I think. Despite the Nasdaq's record high, U.S. equity funds actually saw substantial net outflows last week, $10.44 billion.
Outflows, while the Nasdaq hits a record.
Exactly. The biggest outflow in 5 weeks, in fact. This suggests potentially a growing divergence between the momentum rally in a handful of tech giants and maybe broader institutional caution.
So like smart money taking some profits, maybe?
It could be interpreted that way, like they're anticipating a potential economic slowdown even as retail enthusiasm for AI keeps driving those headline stocks. It's a real paradox.
Okay, what about rates and credit? You mentioned yields were up slightly?
Right. U.S. 10-year Treasury yields rose to 4.07%.
Yeah.
This reflected both those expectations for a Fed rate cut next week, but also, interestingly, rising term premiums.
Term premiums. Explain that quickly.
Sure. It's basically the extra compensation investors demand for the risk of holding longer-term bonds. It can reflect uncertainty about future inflation or interest rates down the road. So yields up partly due to rate cut hopes, partly due to longer-term uncertainty. European yields also climbed, and that was largely due to those concerns around the sovereign rating reviews we just discussed, especially France.
But what about corporate debt, credit spreads?
Now that's compelling. Credit spreads actually narrowed further. The ICE BOFA investment grade OAS, that's the option-adjusted spread, a key measure of credit risk premium, fell to 0.78%, and the high-yield OAS fell to 2.78%.
Narrowing spreads means less perceived risk, right?
Exactly. It points to pretty strong corporate risk appetite. Companies seem supported by decent earnings, maybe, and certainly by the anticipation of lower interest rates. They're feeling relatively good, even if the macro picture looks a bit, well, hazy.
That's a fantastic breakdown of the institutional and corporate side. But what does all this mean for, the average person thinking about something really personal like housing?
Right, good question. For real estate finance, there is actually a potential bright spot here for homeowners and maybe prospective buyers. The 30-year fixed mortgage rate dropped. It fell by 15 basis points down to 6.35%. And that marks its largest weekly decline in a whole year.
15 basis points. That's significant in the mortgage world.
It really is. And
Yeah.
Freddie Mac has already noted that this drop is spurring purchase applications. So it offers a much-needed potential boost to a housing market that's been really grappling with affordability issues. A genuine pocket of positive news for many people.
Okay, that is good news. What about foreign exchange? The dollar was up slightly.
Yeah, the U.S. dollar index saw that slight gain to 97.58. Primarily just investors adjusting positions before the Fed meeting next week. Nothing too dramatic. The euro held pretty steady against the dollar. That followed signals from ECB officials that their rates are likely staying on hold, probably until sometime in 2025.
So no cuts expected there anytime soon.
Doesn't look like it. The pound, however, slipped a bit, mostly due to that weak UK GDP data we mentioned earlier. And the yen weakened further as the Bank of Japan just keeps maintaining its ultra-loose monetary policy. They remain a real outlier among the major central banks.
Got it. And commodities, you mentioned oil was up on the drone strike. Anything else driving that?
Well, the direct catalyst was definitely that Ukrainian drone attack on Russia's Primorsk port, disrupting loadings. But adding to the uncertainty, you have the G7 discussing potentially imposing tariffs on countries that are still buying Russian oil.
Ah, right. That could tighten supply further.
Exactly. It adds another layer of supply uncertainty, creating a potential sort of double whammy for energy prices down the line. And gold's near record high, as we said, continues to be a very clear play on those anticipated Fed rate cuts. Investors are seeking non-yielding assets as a hedge against maybe future inflation or just general market volatility.
Okay. And finally, crypto. Bitcoin's big jump.
Yeah, Bitcoin showed that really impressive surge to $116,777. It just highlights very strong speculative interest right now. And there's a perception, I think, that digital assets could significantly benefit from falling real yields.
Because the opportunity cost of holding them goes down.
Precisely. And the coin's now up roughly 25% year to date. It's seen as a kind of high-octane alternative when traditional assets yield less, and that seems to be attracting a fresh wave of capital.
If you're looking for intelligence that doesn't just keep up but actually keeps you ahead, Nextsight delivers. They support executives, analysts, and investigators worldwide with insights that are not only reliable but immediately actionable.
Okay, wow. With all these moving parts across global markets, I mean, from sovereign downgrades rattling confidence to tech hitting new highs, what should we really be watching for next week? What are the key catalysts that could genuinely shape the market's direction? Maybe amplify these divergences or perhaps resolve them?
Right. The catalyst calendar for next week is absolutely packed. The headline event, no question, is the U.S. FOMC rate decision and then Chair Powell's press conference. That's on September 19th.
And the cut is basically baked in.
A 25 basis point cut is widely expected, yes. But the absolutely crucial element will be the guidance. What do they signal about the pace of future cuts? That guidance will likely drive yields and equity multiples much more than the actual cut itself.
So watch the language, not just the action. Absolutely. We also have monetary policy meetings scheduled for the Bank of England and the Swiss National Bank. Again, their forward guidance will be closely scrutinized for any shifts in sort of the global monetary policy picture.
Okay, what about data releases?
A lot on tap there, too. We're looking at the Eurozone's final CPI reading that'll give us inflation signals, the U.S. Empire State Manufacturing Survey for a read on industrial health, UK unemployment figures are due, and then key U.S. data, retail sales, and industrial production numbers. Plus, Germany's ZEW expectations and China's retail sales and industrial production, those will provide vital insights into global economic momentum, especially for supply chains.
Busy week for data watchers. Any earnings?
Yeah, capping it off, we get corporate earnings from Adobe and RH. That'll give us a glimpse into enterprise software demand on one hand and high-end consumer spending on the other. Tells us how those key sectors are faring.
That's a really comprehensive roadmap for the week ahead. But thinking beyond these scheduled events, what are maybe the biggest, less predictable risks? The things that could genuinely disrupt these expectations and maybe lead to some unexpected market volatility?
Good question. I think the first major risk we have to keep an eye on is that French political crisis. Fitch's downgrade highlights the very real danger of stalled fiscal consolidation, especially amid all that political fragmentation. Markets are definitely concerned about potential contagion. What if other rating agencies follow Fitch's lead? That could trigger forced selling of French bonds, which would be messy. So we need to watch for any key parliamentary votes on budget measures, any signs of government instability. It really feels like a bit of a powder keg.
Right, the political angle is key there. What else?
Secondly, monetary policy surprises are always a significant risk. Unexpected hawkishness, or maybe even unexpected dovishness, from the FOMC, the BOE, or the SNB could dramatically alter market sentiment. For instance, a larger than expected Fed cut, say 50 basis points instead of 25, could really rally risk assets. But a hawkish pause, if they surprised everyone and didn't cut, might send yields soaring and catch a lot of people off guard.
And Japan. You mentioned they're an outlier.
Yes, and there's building speculation about the Bank of Japan potentially tweaking its yield curve control policy. Seems minor, but it could jolt global bond markets significantly, impacting everything from pension funds right down to mortgage rates worldwide. So keep an eye on the BOJ.
Okay, political risk, policy risk. Anything else?
And finally, geopolitical tensions. They always remain a critical factor. That G7 proposal we mentioned about imposing tariffs on countries buying Russian oil, that could widen fault lines in global energy markets, potentially leading to higher energy costs everywhere, hitting consumers and businesses.
And the war itself.
Exactly. Any further escalation of the Ukraine war, especially things like additional attacks on Russian energy infrastructure, could easily push oil prices even higher and trigger a broader global risk aversion, a flight to safety. What we're really seeing, I think, is how intricately these political, economic, and geopolitical factors are all woven together now. It creates this incredibly complex and constantly shifting risk map for investors. The key takeaway isn't just the events themselves, but the potential domino effect they could trigger across markets that might seem unrelated at first glance.
That perfectly wraps up the Friday, September 12th, 2025 Intelligence Brief delivered to you on this Saturday, September 13th edition of the Financial Intelligence Deep Dive. It really is a market defined by divergence, isn't it? Where tech highs seem to clash with underlying consumer fears and where national fiscal health is clearly being judged with increasing, maybe even unforgiving scrutiny. The big question for you, listening, is how will these contrasting forces play out? And maybe where will the next unexpected pivot point emerge from all this complexity? Don't forget to subscribe on YouTube and Spotify. Please drop us a like, share it, leave a comment. We really would love to hear your perspective on all this. And may your Saturday feel significantly lighter than a portfolio with absolutely no exposure to tech volatility. Thanks for joining us.